Welcome back. We're going to now talk a little bit about option pricing. A very, very crucial element of options trading is the option pricing element. It can get a little bit confusing, so let's take some notes here. In fact, the first part of this section is called the Black-Scholes model. The Black-Scholes model is a Nobel Prize winning formula published in 1973. Now, although options have been around a long, long time, 1973 is when we started using the Black-Scholes model to help us price options. Now, I'm not going to go into the intricacies of the model because that's not necessary. Again, I remember using this analogy from my stock class. I use this in my workshops. Very few of you know exactly how your car started this morning, okay? We don't need to know everything about everything, but it's key to understand that this model incorporates the current stock price, the strike price, the time until expiration, the cost of money, the Fed funds rate, as well as volatility. Now, a huge factor, probably the largest factor there, is the volatility and how the volatility affects the price, the movement of the stock. Well, let's go over an option quote. Let's go over the basics of an option quote so we can use this to help us profit. Number one, all option quotes contain two parts. Intrinsic value and time value equals the option quote. So if we have the intrinsic value is actually the true value of the option. So in this circumstance, the stock price is $26 a share, and the strike price of our option is $25. Well, if you'll see there, let's follow along with the slide. It says the intrinsic value is the true value of the option. Therefore, 26 subtract 25 is the intrinsic value of, obviously, $1. So that is the intrinsic value. That's exactly what the option is worth. It's hard value. It's intrinsic value. So let's do this kind of quickly. $80 stock, okay, and you buy the $75 option. Intrinsic value, $5, right? If you have let's say an $18 stock and you buy the $17.50 option. $18 stock, $17.50 option, 50 cents of intrinsic value, okay? Just the fast math. We're going to be doing a little math, basic stuff, elementary school, middle school. For some of us, maybe this was college. I don't know what it is. I'm not very good at math. I got some basic subtraction and addition done. That's all we'll need here today, okay? Next, if we have the stock price, let's take a look at this. The stock price, there we go. The stock price is $28 a share, and we were to buy the $25 strike price. Again, do the math. 28 minus 25. The intrinsic value is 3. All right, that's it. It's the cost of the option. That's the intrinsic value. Now, on top of that, once we know intrinsic value, the intrinsic value plus time value is the option quote. Time value is the additional amount the option seller adds to the option quote to compensate himself to be at risk of the underlying security over time. Let's go back to my house analogy. Let's use the same analogy that we've used so far. Let's say you have the house that's $100,000, and instead of buying the $100,000 option to buy your house, we buy the $95,000 option. Well, that now has intrinsic value. How much of value does it have, guys? How much? $5,000, you've got it. Well, that means that option at least is going to be worth $5,000, and then now the option seller is going to adjust that for time. Let's say it's only 1 year. Well, then the option seller would add 1 year of time. If it's 30 years, would the option seller add an exorbitant amount of time? Yes, absolutely, because time is worth something. So it's intrinsic value, whatever the actual value of the stock is, minus the option price, okay, the strike price, and then let's say now add time. So in this circumstance, the stock price is $26, and you're looking at the $25 call. Let's go back. The option quote, the option quote is $2.50. So let's go back. See the stock price. There's my little arrow. There we go. Stock price is $26, and you're looking at the $25 call. So gentlemen, what is the intrinsic value? It is $1. Therefore, let's do simple math. If the option quote is $2.50, subtract the intrinsic value, that means our time value is $1.50, all right? All we're doing is basic, what is that, basic algebra, I guess, right? X plus 5 equals 8, X is 3, right? X plus 10 equals 12, X is 2, okay? That's all we're doing, all right? So let's do this again. If the stock price is $27, you're looking at the $25 call. Well, that means the intrinsic value, obviously 27 minus 25, that's $2, and it's $3.70. Well, therefore, $3.70 minus 2 is $1.70 for time. That's the value of time, okay? Deciphering an option premium. Now that we know the components of this, we have time value as well as intrinsic value. Let's now talk about a little bit more esoteric, if you will, part of the option price is historical volatility, implied volatility, and theoretical value. Let's start with historical volatility. The historical volatility then judges the stock's historical volatility over the last 6 months. So, historically, the stock moves how much? It moves up this much, down this much, from the tops to the bottoms, from the bottoms to the tops, et cetera, et cetera, et cetera. That is its historical volatility. So it has a history of baseline X, okay? Now that's its historical. Now we go over here and we have, now that's judged against our implied volatility. Implied volatility is its expected volatility. That is into the future. Now, the implied volatility is almost always, if not always, higher than historical because we have variables there, don't we? We know what the historical is, that's the baseline. However, we need to adjust for the future or the implied volatility. The implied volatility literally has the most to do with what we're talking about. The implied volatility has the most to do with deciphering option premium. Next is the theoretical value. The theoretical value is what the option really should be worth. What the option should be worth. So we take our theoretical value, that is according to the Black-Scholes model, that is the textbook, this is what the option should be worth, and we find out, should we be buying this option? Is it overvalued or is it undervalued as it compares to our model? Obviously, what we'd want to do is we'd want to buy undervalued option. We would employ buying strategies. We would be buying puts. We'd be buying calls. If the option is overvalued, we would be employing selling strategies. We would be selling naked options. We would be selling overvalued options during spreads. That's covered in our advanced class. We would be employing selling strategies. So we buy undervalue and we ideally sell overvalued. All right? Be careful. All right, because you can get caught very, very quickly if you mix these up. All right, you will lose money unless we kind of understand these concepts. That if you're watching these DVDs for the first time, you're not expected to even get this the first time, okay? This is just a key component, one of the favorite sections that your coaches will be going over. Now, this is much more advanced. The delta, the gamma, the theta, and rho, those are all much more advanced concepts. Those are called the option Greeks. If you're a market maker, you know exactly what I'm talking about. In fact, it was funny. I talked to one of my, and I consider myself fairly well versed in this. My friend, who was one of my mentors in this business, I said, how are you doing in the market? You know what's going on? He's a market maker, and he trades Qualcomm and Texas Instrument, and he says, I'm short a whole lot of Vega right now. I'm looking forward to making some money short term. Now, that didn't make any sense to maybe anybody, even in this room, or maybe you at home. That's an advanced type concept. Those are the option Greeks. You don't need to know that information right now. By the way, kind of humorously, this gentleman is getting older. He's retired now. He's now 34. And I said, how you doing in the markets? How much money are you making? And he came to me. I thought it was great. He said, the last quarter ending, I paid my estimated taxes. And I go, really? How much money are you making? And he said, ha, 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 ha. I said, what? Does that have a comma in it? What does that mean? He said, Michael, I paid I remember this like it was yesterday, $335,000 in the last quarter estimated taxes. And I said, Shazam, all right? How many of you guys, would that be a fun, can you imagine writing out that bill every quarter? Now I know that there's a little bit of a paradigm shift for you, but if you made that, if you're writing that to your, Uncle Sam, did it also mean you made a couple bucks? Yes or no? Right, I mean, I'm all about paying taxes. It's a function of doing business, right? Cost of goods sold, it's part of doing business, okay? So anyway, that's kind of a fun example. Volatility, that measures the magnitude of the stock's movement, not the direction, all right? So you could have a stock that trades fairly flat, but very volatile. It goes from 30 to 40, slams down to 30, then goes up to 40, slams down to 29, goes up to 28, it's very, very volatile. Not necessarily a bullish trend or a bearish trend, just volatile. A key factor, this is a key factor in an option quote. Volatility is what it's all about. This is part of the reason, I'm going to spend some time on this. This is part of the reason it's very, very difficult to learn this unless you have somebody walking you through. Volatility is a bit esoteric. Let me give you an example. Coca-Cola. I enjoy Coca-Cola products or Diet Coke or whatever you choose your favorite flavor. If you were to sell or you go to a soda machine or a pop machine and you buy a Coca-Cola product, you'd pay 50 cents or $1. Let's say it's 50 cents for a can of Coke these days. Maybe it's a cheap soda machine. All right. So there's 50 cents, and that's what it's worth. It's kind of like a stock. That's what it's worth. It's worth 50 cents. That's it. If you go to Boston, you go to Savannah, Georgia, my friends in Baton Rouge, or you go to Texas or California, it's 50 cents. Now, the unique thing, though, is volatility is kind of like this, is the price of the option really has to do with the volatility. It's kind of like Coca-Cola. To anybody here, it's worth 50 cents. But if you go in the desert, in the Sahara Desert, where it could maybe potentially save a life, would somebody pay thousands for that? Probably. Yes? Yeah, it's you'd think the same thing is different, okay? It's kind of hard to get your arms around it. Volatility is kind of like that, all right? If the stock is estimated to be very volatile, the options will be very expensive, all right? So volatility is what we're talking about here. A key factor. Helps determine if a stock is fairly priced, overvalued, or undervalued. High volatility creates expensive options. Historically, we don't buy expensive options, we sell them. That's where it's beautiful in this business because we can sell naked options or we can sell covered calls. We'll be talking about covered calls today. Low volatility means less expensive options. That's ideally what we're looking for. We're looking to buy cheap options and sell expensive options, okay? Historical versus implied. Now, the historical volatility shows the historical level of volatility for the underlying stock. Think of this as the average volatility. So the historical or the average volatility, that is what is our baseline. So now that said, that's our baseline, the stock, like a support and resistance level almost. That's our baseline. It usually does this. We know from our past history. We can use our computers to give us that historical. Okay, we know that. Now our implied volatility. Again, that's the key issue here. The implied volatility measures the current volatility of the underlying stock. When compared to the historical volatility, it can be determined whether the stock's current volatility is above or below normal. So let's say we have a baseline here, all right, and then we have the implied volatility is very, very high. This happened oftentimes. I remember trading this. We would trade drug stocks. We were trading drug stocks, and it's an expected a phase 3 drug announcement, an FDA approval of a drug. The implied volatility of the options would go through the roof. Now think about that. Let's say it's a regular XYZ drug company. Doesn't matter what it is. And the historical volatility is here. Just flat. And then all of a sudden we're faced with, at the end of the month, the FDA will say, hey, we give our blessing to this drug, and that means we're going to get these on the market. Is that going to be profitable for the drug company? Yes or no? Absolutely. So we don't know the reason why the implied volatility gets so high is we don't actually know if the FDA will approve the drug. So the market maker needs to adjust that by pricing the options very expensively, okay? So that's a little bit about the implied volatility, all right? We don't know, so when the market maker doesn't know, what he does is he makes it expensive. So be careful. In historical versus implied. So if the implied volatility, let's use my little arrow here. If the implied volatility is higher than historical volatility, the option is overvalued. If the implied volatility is lower than historical volatility, it is undervalued. And if the implied volatility is fairly close, it is fairly valued. All right? So again, these are new words, new vernacular, if you will. That's okay. We're going to be using these. It's kind of like when you learn Spanish or you learn a foreign language, whatever it may be, they teach you in that foreign language. I'm using maybe a bit of a foreign language. We use it all day. You and your coaches will become very, very comfortable with this as you learn more about it. Volatility comparisons. Right over here, CHS, that stands for Chico's Fashions. We have our corporate snapshot. Scroll down underneath here. Right here as we see our listed options. That is our standard option quotes. That's where you'll see your calls and your puts. Underneath that, that's our option Greeks. That's where you'll see your delta, your gamma, the theta, the volatility, and your t-value or your theoretical value. The t-val or theoretical value, that is according to the Black-Scholes model, what the option, quote unquote, should be worth. Beneath there is your over-under evaluation. By the way, you may find myself, and you may find your coaches a little bit excited about this. I have not seen this information on any other website ever. proprietary information, all right? That's why we're a little bit excited to be able to literally spoon feed this information to you. You don't have to research like I did 7 years ago and get an agreement with this website, this website, this website, know this guy who knows this, and get this data feed. And I mean, it was just a headache, a nightmare. It's all point and click at your fingertips, okay? The over-under evaluation, then comparison tables for volatility and theoretical value. Are you paying too much for this option? And lastly is our Black-Scholes calculator. So let me show you this. Chico's Fashions, okay? That's an example we're going to use all day, not all day, but I mean in the short term here. Is the option over or undervalued? First of all, the option, let's go right over here to see the stock. The stock is 32.87. 32.87, okay? We'll go over here to the historical volatility. Let's go over here to historical volatility. A baseline, the average volatility, you'll see it's 25.42, 25.42, even down here in the next month, 25.42. So on average, Chico's Fashions has a historical volatility of 25, let's just use 25%. That's fine, okay? That's our baseline, that's our average. Look to the past, that's what it usually does. Okay, now, let's look to the future. Let's find out what it's implied to do. Well, the implied volatility in these options, this one right over here is 31%. This one right over here is 35%. This one right over here is 31%. Well, let's find out, is this over or under valued? Well, you go over just to this column right over here, and you can see, is that option over or under evaluated? Well, we go right over here to the first one, that $30 strike price, that's 24.5%. Now, as you look at this, folks, if you kind of concentrate on me here for a second, is that you're always going to be buying, options are almost always overvalued. Very rarely do you find one that's undervalued by a certain percentage. An average overvaluation of an option is about 20%. That's about right. And think of why that would be. We know the past is a constant. We don't know the future. We can't make them the same. That's not good business. You're going to charge you more for future prices. It's just the way it is. Like my dad said, it's just the way it is, son, okay? So expect the future. It's unsure, so we're going to use about a 20% baseline. So if it's about 20%, that's about average. Well, let's look at this one right over here. The October $30 call option is 24%. The 35 is about 39.5, and the 40 is 22%. Well, and these two, if you just compare these two, the 24 and the 39, obviously we would want the one that's the lowest. The closest to our 20% kind of baseline there. So that's our historical versus our implied volatility. Now, we know a little bit about that. Let's use our theoretical value, and we're going to put it all together here, okay? T-value. The theoretical value of an option based on the Black-Scholes model. It's also known as the fair value. What is the fair value of the option? It is used to determine if the current price of the option is overvalued, undervalued, or fairly valued. Again, we're going to be looking for about 20% or under. If it's much more than 20% or much more than that, we know we have a very, very expensive option. If you're buying expensive options, be very careful. That's where most of you may be losing your money, okay? I'm discouraging that, okay? Here we go. The T-value is right over here, all right? Let's focus on this chart here for a second. T-value, the symbol CHSJF is $2.89. That is what, quote unquote, the option should be. That's what the option should be priced at. Well, let's take a look at the bid price and the ask price. Well, the bid price is $3.20, and the ask price is $3.30. As you know, we're going to be buying at the ask price, the $3.30. Therefore, it is the theoretical value, it is 14% overvalued. Is that within 20%? Hey, that is an appropriate, that's within our threshold of pain here. That's within our construct. Okay? If we go to the next option, and here's where these tools will absolutely stand out. If you've learned options before, and if you've come here to our class because you've made mistakes, which we've all made mistakes, no big deal. If you've learned options, and again, I remember the student here, I've said this in our stock class, student said, hey, I want to learn options from a book They bought a $25 book. $150,000 later, they came to our class, okay? So just learn it the right way, okay? You may have never known this information. You may have never even used this. This is pretty much one of the only things I use so I know if I'm buying the right option, okay? So come with me. Look at how this will now start standing out to you in the future. Look, the next strike price is right over here. There it is. It's the 35. The theoretical value of that option is 30 cents. It should be about 30 cents. Let's scroll over to the right. The bid price is 65 and the ask price is 75 cents. You and I would be buying this at the ask price. Well, let me think. I'm going to be buying it at 75 cents. It should be worth 30 cents. That is grossly overvalued. Consequently, you'll see right over here where it says overvalued, it's about 150% overvalued. Is that within our construct of 20%? Obviously no. That's where the majority of people will be losing their money. They don't either understand this, they were never taught this. That's fine, don't fault them, I don't fault you. Now that you have these tools, don't go back to what you were using, which is maybe a gut feel or something like that. You know, a gentleman came up to me and says, Michael, I've already made literally hundreds of thousands of dollars in the option market. I've retired, I consult for a living, but I love options. I need to get back and use them. I haven't used them since 2000 when it was kind of easy to make money. And I said, so you didn't trade puts? He goes, no, I didn't learn how to trade puts. And I said, well, you got to learn how to play the up and the down. I mean, come on. I mean, that's, and he said, you're right, I do. He saw these tools and he said, Michael, he said, he was from Texas, so pardon the pun. He said, Michael, he said, learning about these tools with options, he goes, it's like going to a knife fight with a chainsaw. I said, wow, geez, you don't hear that often, going to a knife fight with a chainsaw. But, these tools are what we should be using, okay? So that's our theoretical value, the ask price overvalued, all right? So that's our theoretical value. When you're going to pull up your options with your coach online or as you go through your coaching sessions, this is a key part of their decision making. Is your option overvalued or undervalued? Now again, the Greeks covered in our advanced options class. Why do we have an advanced options class? Most of you folks in a very short period of time are going to use our concepts to pay for all of your tuition of your courses, your master's courses, etc. Then you'll say, hey, well, I need to learn more about this stuff. You'll come back to us, and previously we didn't have anything for you. So now we have advanced options courses, and our alumni are coming back to us. I need to learn more. I want to have a lifetime of education, and we'll cater to those needs as we progress, okay? So our option quotes contain both intrinsic and time value. Compare implied volatility to historical volatility to see if the option may be overvalued. A 20% premium is approximately acceptable. Compare the T-val, the theoretical value, to the option price to see if the option is fairly priced or fairly valued. A 20% premium is acceptable, all right? So that's a little bit about the option pricing. Now, let's go ahead and start talking about forecasting trends. Now, this is going to be a little bit of a review. We're also going to have a new area in here called forecasting the chart pattern. You're going to kind of know this information. In your gut, you're going to be like, I knew that. I could have brought that up. It's kind of like the books. Has anybody ever heard of Rich Dad, Poor Dad? If you ever heard of these books, they're fantastic books. I would recommend that you read them. Now that said, they're very, very common sense books too. Some of them are new concepts and new words, but the concepts that he teaches are